Hi there, I'm Ross Woodfield. Welcome to BlackRock Global's daily market update. The euro saw plenty of action late on Friday with some disappointing data, followed by positive news on the Greece issue. Manufacturing PMIs disappointed for France, Germany and the EU, with the French PMI dipping back further into contraction at 47.7, while Germany's PMI remained flat at 50.9. The services industry fared a lot better, showing growth, but the manufacturing results dominated. And later in the day, the euro rebounded as news filtered through that Greece had been granted a 4-month extension to its bailout loans, which were due at the end of this week. The euro failed to break out of the range, however, as the market did not really see this as a resolution, rather delaying the inevitable. Many believe now that we will be in the exact same situation come June, and we see further downside risks for the euro as a result. And looking now at the pound, and it took a dive late in the week, which saw it break lower out of the rising wedge that it had formed. Core retail sales were disappointing at negative 0.7% month on month versus the expected negative 0.2%. The pound could have a tough time to regain the ground given the breakout of the technical pattern. The market will be looking ahead to the preliminary GDP figures due out on Thursday this week, which are expected at 0.5% for Q4 2014. This would be a good result given the faltering growth plaguing its closest trading partners. And finally today, one pair to watch this week will be the AUD-NZD cross. The pair pushed out to an all-time low at the end of last week as it inches ever closer to parity. It managed to pull back late in the week as it continued and has continued this week as the market rejects off the lows. The talk of further rate cuts from the RBA and a drought affecting the New Zealand economy make this pair an interesting one for both technical and fundamental traders. That's all we have time for today. For BlackRock Global, I'm Ross Woodfield. Thanks for watching.